All right, everyone. Welcome to episode number 53 of Going Live with Good Soil. Matt, how is it going? Did you have a good 4th of July weekend?
Yeah, we did. Busy, but we did all the fun stuff of grilling and swimming and fireworks. So yeah, it was nice. How about
Yeah,
yourself?
same thing. Yeah, went to a county fair here and didn't catch any fireworks. They don't go off till like 9:30 or 10. And our kids, our youngest especially, he struggles when he goes to bed super late. So so we just didn't feel up to doing the fireworks this year. But well, there was like a big, I don't know, where we live, there's like lots of fire alerts, so no one really does any fireworks. It's like against the law pretty much, except for like a couple special places or something. So we didn't miss out too much this year. But we got the production and delivery report. We'll go into that in a second. But the macro market first. We usually talk about that first a bit. Um, it seems like the Atlanta Fed is more aggressively even pricing that we're in a recession right now. I saw some adjustments to their estimates for Q2 GDP being like -2% or something now too. So it seems like the Fed, they should be getting the signal. They should be getting the signal amongst the noise that even though they've been denying publicly that they don't think we're going to go into a recession, technically it seems like we are in a recession because a recession technically is 2 consecutive quarters of negative GDP growth. And if there's a GDP print for the second quarter of a recession, a negative, then it's by definition a recession, right, Matt? Am I missing something?
Yeah, no, that's my understanding as well. So I think it's a lot of people have been expecting this for a while now, and it seems like the the Fed is like the last to realize that we're in a recession. So
They were the
uh,
last to realize inflation, right? Transitionary, but
transitory, yeah.
transitory. Now they're kind of late on the ball in the recession, seems like.
Which might be to me this is one of those bad news is good news kind of things, at least for markets, where
Yeah.
I think that the commentary a month ago was the economy is relatively strong, but inflation is rampant. So like the Fed is justified in kind of using every tool in their arsenal to slow down the economy in order to like put a lid on inflation. But I think with where things are going right now, there's more of a recognition that the economy is actually in a pretty precarious, weak spot. So that may give pause to some further rate hikes going forward.
Yeah.
So I think it's not necessarily a bad thing. I mean, this is the sort of thing that has been pretty clear to most other people, I think, for a while now.
Yeah.
But we'll be interesting to see how if and how and when inflation actually does kind of get under control. I still do think it will, in the second half of this year, which we're already in the second half. But we need a couple prints where the monthly inflation report is not plus 1% quarter over or month over month, something like that.
Yeah, yeah, and I see a good comment from Darboy in the YouTube live comments. Says, "What's the point of the Fed again?" But I think there's a serious question to ask too. Like from a first principles, kind of most basic point of view, the Fed has like the two mandates, which is what is it, unemployment and inflation, right? Trying to
Mhm.
optimize those two. And I think they have a target of like 2% for inflation to be set around. That's okay or something. And unemployment, I don't know what their goal is, but just maybe get as low as possible. But a recession signals that unemployment's going to get worse. Is that about right? Why they want to fight against recessions? I mean, it doesn't seem like a recession directly is something they want to stop necessarily from their mandates, but from the fact that their mandate of keeping unemployment from getting too
Yeah.
high, it seems like that's why a recession they'd want to stop that, right?
Yeah, exactly. So, I mean, their two mandates are like full employment and inflation. So, if the economy, reasonable inflation, I forget exactly how it's worded, but
Yeah,
if the economy, weakens too much because of overly aggressive rate hikes, then that can cut
yeah,
across, one pillar of their dual mandate, which is the full employment. So, um, I kind of think they're gonna have to. Stop the kind of aggressive course of rate hikes that they're on, because if they don't, then they're going to cause so much damage to the economy that you would have kind of employment losses. I mean, we're already starting to see this. A lot of companies are doing layoffs, Tesla among them, or just changing hiring policies. A lot of companies have just stopped hiring or done hiring freezes. So it may
yeah.
take some time for all this to kind of work its way through the economy, but I think you're going to start to see kind of deteriorating employment figures, and well, just
Yeah.
I don't know. I'm kind of curious to see how this plays out, but I do think
Yeah.
it's going to be a kind of they're going to have to reassess and be like, oh yeah, we were wrong again for the 18th time on
Yeah.
like what we
Yeah.
thought the economy needed.
I don't think they would admit it though. They'd probably just say, "Hey, we think." I don't know what they'll say, but yeah, I feel like they'll take a lot of heat if they admit they were wrong. Like they sort of admitted outwardly they were wrong on inflation. I think, or I don't remember the exact words, but yeah, it would make them look really bad if they admit again they were wrong like 6 months later on this. You know, so it's such a big thing. So I feel like they'll just more kind of passively become a little more dovish or just not raise rates by 50 or 75, maybe 25 or so. I don't know. Kathy Wood had a good in the know episode recently, but also listen, she thinks they're going to come around. Basically, her economic prediction or analysis is that the Fed has to come around and slow down interest rate tightening, maybe not tighten interest rates at all in July or just 25 basis points, but not 75, And then Chamath on the All In podcast, who's another like guy I listen to for Signal. He thinks that the Fed is going to keep, they put out their marching orders and they're going to just keep raising rates 50 to 75 basis points for the next several, meetings until the CPI prints or whatever are below like 8% or something or 7%. So you got two conflicting predictions there. Would you have any thoughts on which one's right? I mean, those are both from their most recent like interviews or podcasts in the last couple of days. On what do you think, Matt?
Yeah, I mean, I do think we're kind of prone to see some deflationary pressure. I mean, we've already seen a lot of commodity prices really correct downwards pretty aggressively. Oil has not done so to the extent that a lot of the other, like metals have, in lumber and even wheat, which is like, 6 months ago, people were saying there's going to be like a worldwide food shortage and like wheat scarcity is going to, cause starvation. And I'm not saying we're out of the woods on all that stuff yet, but the markets seem to be sending a signal that commodity prices were way overheated on a lot of the concerns that we had. And so I think those coming down to the degree that they have so far is counter inflationary pressure. You couple that with, the inventory bullwhip that Kathy and now even Michael Burry believes that. To me, it's just that line of reasoning makes a lot of sense.
Yeah.
So that's kind of, I'm leaning more that way. I mean, I'd probably say 70-30, Kathy's argument versus, Chamath's in terms of probabilities I would put in my mind. But I don't know, what's your thought on how it's likely to play out?
I'm torn. I'm 50-50. It depends, is Powell and the Fed, are they just stuck in like this hawkish mode, or can they pivot out of it? Are they going to look silly pivoting out of it, too soon? Or does it make them not? Do they save their egos and just stay hawkish and not pivot, even though it might be the right thing to do at this point? So, I think the right thing to do is to pivot and maybe raise interest rates, 25 basis points or nothing to, for the next couple meetings, kind of see how this plays out a little bit more, because I don't think raising interest rates 75 basis points, in, twice in 2 months is going to be that drastically different than raising it 75 basis points twice in 4 months, like for fighting inflation. Like, I don't think that difference of 2 months is going to like suddenly stop inflation versus not, so I think the right thing is for them to kind of wait and see a little bit at this point and see more data before they more aggressively raise rates. That's what I think they should do, but I don't know if they will.
Yeah. It's going to be, interesting to watch it play out. But I do think they could claim victory, if they do pivot. They say, oh, the aggressive actions we took to, raise rates, but in an unprecedented fashion, really worked to, tamp down inflation, and so we've won basically. Like I'm sure they can find some way to paint a victory out of that. So
yeah, they need some victory for sure. Yeah, they need that. That's what they probably, anyway, power corrupts all of us. And when you're the chairman of the Fed, believe it, you have a lot of power, and no matter how good of a person you are, you're going to be somewhat corruptible to it, I think. And your ego plays you don't want to look terrible by changing your mind 3 times, admitting mistakes so many times and everyone hating you potentially, or, whatever. So I think that they'll try to admit victory somehow, for sure. All right. So next is the production and delivery numbers for Tesla. Let's move on to Tesla. First of all, Elon is back on Twitter. Hooray. I've missed him. he was gone for a week or almost a week and a half or more, and we're all like, where the heck is he? Where in the world's Elon last week? That was kind of the theme, and now he's back, and he tweeted was he in Venice, I think, or with his kids, or he was in Italy and
He was
was
in
visiting the
Italy.
Pope.
Yeah, he
Yeah,
saw the Pope and was in Venice, I think, with his kids. And
yeah.
who was that was with him? I couldn't remember which woman it was. One of the women that
Hmm.
he dated a long time ago, right? Or maybe one of the ex-wives.
Oh, Tallulah Riley. I think he was
Riley.
showing.
Okay.
Was that with him there, or was that a picture of a few years ago? I
I
can't
assumed it
remember.
was there since he was posting another picture in
Yeah.
Italy, but I don't know. It was.
I would think so. Maybe I interpreted it wrong. But there was also a lot of other people. Like I saw that Steve Jurvetson said he was in Italy for a wedding. Whose wedding was it? Does anyone in the comment section know? Like, was there some famous person like in the Elon, Steve Jurvetson, like, and there was a couple other people, I can't recall that, like the girl who's like pretty popular, Liv Boree or whatever. She was in Venice, I think,
All
and
right.
all these people kind of in a similar circle, I think, were there for some wedding. Does anyone in the comment section know? And I'm assuming that's why Elon might have been there too for some wedding. So I wonder who
The
it was.
Pope's wedding.
Pope's
Yeah.
wedding. No, I don't think it was a Pope's wedding, but it was like that's my suspicion. I don't know, but it was probably kept on the
Yeah.
DL to some degree. I don't
I
know.
thought it was just a good thing to see him out doing something social, and I feel
Yeah,
like for his mental health, it's good that he gets these breaks and spending some time with his kids. So,
absolutely.
especially after what was probably a pretty insane end of quarter, it was really nice to just
Yeah.
see him doing some socializing and a little bit of downtime, which is rare for him.
Yeah, yeah, that is true. Yeah, I'm sure it's a good rejuvenation for his mind just to, but I still think he was probably using a burner. He probably couldn't keep away and was checking Twitter on a
I think
burner
you're right.
account.
Probably
I don't
posted some
know.
dank memes that nobody will ever see.
Yeah. I mean, he's about to take over Twitter. He's about to use like a significant percentage of his fortune to take over Twitter. So I would imagine it's hard for him to completely stay away for like a week or two straight like that.
Yeah.
Yeah. So Elon is back. There's a little bit of an echo I hear. Do you guys hear an echo? Anyone else?
Yeah, sorry. For some reason, my
Okay.
speakers on my computer just turned on of their own
Oh,
accord. That was strange.
no worries. We had a great chat with the battery and mining that we posted on our YouTube channel as well with Jordan from the Limiting Factor and Josh goes
Josh
by the
is
name
blonde on
Josh is
Twitter.
blonde. Yeah, he's sort of a mining uh, expert of some degree, or he's analyzed the mining opportunities a lot and the capabilities. And what were your thoughts on that, Matt? The chat with Jordan and Josh.
It was fascinating. I mean, I really like those guys. I've been following them for a while, but just
Yeah.
the amount of knowledge that they have, I thought was phenomenal. So anyone who hasn't listened to it, I'd highly recommend it. I think my biggest takeaway was just how much of a supply chain bottleneck there is kind of coming down the road. It's
Mm-hmm.
very easy in my modeling to go out to 2030 and say, all right, well, maybe it's reasonable to get to 16 million deliveries or something like that. But I think after talking to them, it's more reasonable, I think, than not, that there's going to be a pretty significant bottleneck of some material, probably lithium, but others could creep up as well. So I think I'm probably, it changed my base case to be a little bit more conservative on the deliveries. But at the same time, one of the things that they said, which I think was incredibly bullish, that I didn't see a lot of people commenting on, was the fact that like Tesla is doing all this work right now to secure their supply is going to give them a huge amount of pricing power because they're going to have the lion's share of like the supply for EVs. So if you could imagine a scenario in 2029, let's say, where Tesla has expanded their share of like the overall battery supply chain, and there's increasing demand for EVs just because that's the transition that's underway right now. There's a very realistic scenario that pans out where this kind of demand exceeding supply scenario that we have right now just continues, but at a larger scale. So Tesla may have like some pretty ridiculous pricing power well into this decade, which is not really a scenario that I've been banking on. So I don't know. Those
Mm-hmm.
were the two kind of most interesting points in my mind. Is the supply constraints being an issue for ramping, but also could be a source of margin potential in a roundabout way
Yeah.
for them.
Yeah,
What
I
about you?
agree
I was
with you.
curious what you thought.
I agree with you. The big takeaway for me is that, lithium is the key component for years to come. Sodium ion is not really practical to have, terawatts for many years of capacity. So you still need to rely on lithium, and lithium constraints are serious, and that there's enough for the next couple of years. So in a way, Drew Dixon, the bear we had on our channel, is sort of right in that, we're modeling Tesla growing 50% per year for the next several years, but he's modeling for like the next 1 or 2 years, then they're not going to grow 50% because of competition or whatever. So I think he's almost sort of right in that they can grow 50% per year in volume of production and deliveries for the next, like, 2 or 3 years perhaps, but then there seems to be maybe a slowdown 50% per year from that point forward because of the amount of lithium that can be extracted, not because of competition though. So they'll maintain pricing power and incredible margins, as you were just mentioning, I think, and they'll probably have it'll come on time, hopefully, with the full self-driving capabilities, so that you get much more pound for pound from the lithium by having it in cars that are driving nonstop, 500,000 miles a year versus cars that we buy that drive, 20,000 miles a year or something like that. So I think and then there's the invisible hand, that we all have heard of. What's the famous
Adam Smith.
Adam Smith talks about. And so I think if you have competitors trying to get in, and you have Tesla at the same time at the throats of these miners, like, get me more lithium, then I think there's going to be the market, the invisible hand of the market will hopefully, I have faith that it will figure out ways to extract more lithium, because it's on the planet. There is enough lithium on the planet. The problem is you have like at the current moment, there's like all these kinds of regulatory issues in the US, for example. And China doesn't have that problem, but China, I asked them, doesn't maybe have access to the lithium themselves on their own land, for example. But maybe there's ways where it will be extracted anyway, I think, in due time. So it's a fear right now to think about, but I think the invisible hand will figure out a way to extract enough lithium. But it's something to keep a close eye on.
Yeah, I'm curious how Drew would think about that conversation that we had, because his whole mindset is, the competition is coming essentially, but none of the competition is taking the extreme steps that Tesla is taking to like procure that supply. And so
that's right.
If the transition to EVs happens the way that Drew thinks it will, but like Tesla is just the only one that has enough, it's like, like he may be like right in the generalities, but like just wrong in the execution. So maybe people even would prefer, the different models from the other manufacturers or whatever, but just because they can't ramp up enough, I mean, that may just play into Tesla's hand even more. So yeah, I don't know. I came away from that whole conversation, just with what I feel was a lot more nuanced outlook on how the next, 7 years is likely to play out. So it was a great conversation, I thought.
Great. Yeah. And the competition is coming in terms of prototypes, but in terms of mass scaling, I don't think the competition is anywhere close to Tesla for many years. So we'll see. But in order to mass scale efficiently, they need the manufacturing prowess of Tesla, and they need to secure a ton of lithium and other rare earth materials that are needed. So CATL and Samsung and Panasonic, all the folks that, suppliers of batteries, they want to have their best relationship was with Tesla and maybe some Chinese EV manufacturers for CATL, for example. But, for Volkswagen or Porsche, for all these other car companies that have market caps now much less than Tesla, much less profitable, you got to imagine these suppliers. That's not something we didn't talk about quite as much. It'd be cool to like talk to experts on all the battery manufacturers and their mindsets and stuff, because I feel like they're all going to just do whatever Tesla want. Tesla's the number one customer by far for the foreseeable future. So we'll see.
Yeah.
It's going to be hard for Volkswagen or whoever to like steal supply from CATL from Tesla. I don't know if that's going to happen.
Yeah.
So yeah, and the production delivery numbers came out. We'll go into your model for those of you just listening on Twitter Spaces. we are also on YouTube Live on the Good Soil Investment YouTube channel, and we'll be talking through he'll be showing us his earnings model in a second, and we'll be talking, being walked through it. But you can listen to it, but also it's recorded on our YouTube channel, or you could switch over to it to watch it live or whatever. So yeah, what were your thoughts first on the production and delivery numbers? It seemed to be exactly what people expected. It was right on mark with Troy, for example, and almost everyone. We thought it was right. We said 240 to 270 was our like 90 percentile. That's what I thought. 255 is like right in the middle.
Right in the middle. Yeah.
There's no surprise to anyone. It
Median
seemed
was
like this year. Yeah.
right on point. Yeah. Yeah. I mean, Troy, hats off to Troy. He's been right for a long time. I mean, he was sounding the alarm very early in the quarter, just about like how significant the production shutdown in Shanghai would be for deliveries. And so, I think I was kind of slow to really believe that Tesla wouldn't ramp back up, because Elon had the comment on the Q1 call that said we'll be pretty close to the last quarter, barring something surprising. So yeah, it was that this has been one of the quarters where it's been really helpful to just be so in the know and following people like Troy, who are just like actual experts in this stuff. I mean, the amount of time he spends going through DMV reports and compiling all this stuff, it's like I have the patience to like follow all that stuff in the minute detail that he does. So it's just so great to have that resource. But yeah, not really surprising. I mean, pretty much just right in line with expectations. So I was kind of hoping that they may pull a rabbit out of a hat, but just on all the details, there was that rumor that Giga Austin had really ramped up production to like crazy levels, but the VIN data didn't support that. So it was I think pretty much just in line with expectations. So not a surprise at all. But the exciting thing is just we got a couple shutdowns coming up to increase capacity out of I think it's out of Berlin and Shanghai. So it'll be interesting to see how quickly those can ramp back up and what Q3 is going to look like. Because for a long time, I've just been very, very excited about Q3. So I can't wait to kind of see what those numbers look like, 3.5 months from now.
Yeah, as excited as I am about Q3, I'm even more excited about Q4 too. It's like it's right. It's nice how they, it would kind of be a letdown if they went like, balls to the wall on Q3 and didn't do any factory shutdown. Then they shut down the factories at the beginning of Q4 instead to like get the ramps up. Because then Q3 would be amazing, and then Q4 would be like almost equal, maybe, let's say, because of the 2-week shutdown in Q4. So it's kind of cool how they're. It's even with the 2-week shutdown and pretty much in all the Shanghai and Berlin in Q3 here, they're still going to have record production and deliveries this quarter almost for sure, and by a good margin. And then Q4 is just going to be like everyone, full on the whole quarter. And Q4 is notoriously always like an incredible volume print, like I remember last Q4, I remember like New Year's, the next day after New Year's or whatever, waking up and seeing the 310,000 cars delivered, and everyone was like, blew everyone away. And it was like, wow. So this next Q4, I wouldn't be surprised if it's possible, in the realm of possibility. It's like almost double that. I don't know if it'll get that high, but I'm just saying like, it's probably going to be like 500,000 in the neighborhood of that or something. It may be a little less. I don't know, but it's going to be a lot for Q4. Yeah.
Yeah, and that's when it gets so exciting, because I mean, you got, and we'll go into my model in a minute here, but you got so much kind of bad news compounding on bad news with this quarter, and it's just like it's a very noisy quarter. So it wouldn't I kind of want to trust the market to be understanding about like how many of these one-time items are just kind of like laying in this quarter. But it's possible that like I've had the Tesla Q bears are like coming out of the woodwork. I don't know if you're finding the same thing on Twitter, but like I'm seeing more people like saying, "Oh, Tesla's going to 250. You better like watch out." Like I don't know, they're feeling very emboldened these days. It's like I made some tweet about like, okay, how long until like the first news like sources of like Tesla's falling demand start coming out, because they it was like the first time since the other COVID shutdown that they actually had a sequential decrease in production and delivery.
Yeah.
And so like all these people are like, what? It's facts. Like that's what's going on.
Yeah. I saw some other bearish take on the I follow a few like bearish Twitter handles that are, some are absurdly like ridiculous. They're like anonymous, but then I find others like Drew Dixon, who's like an honest, he's respectable. And then there's like a wide range of Tesla Q, just like there's a wide range of Tesla bulls, but some of the bears were like putting up the German news headline of the Brandenburg plant, plant shutdown, but they were like translated into saying like Tesla is already shutting down its Germany factory. Things are going so badly. I'm like, oh man,
I saw
these.
that. Yeah.
Oh,
I
geez.
saw that, and then I saw somebody else like was tweeting that, oh well, like if the demand is so great, then how come they didn't deliver as many cars as they produced? It's like, well, because they had like 1 day of inventory going into the
Yeah.
quarter. It's like,
Or why do they got to shut down their factories? They're idling their factories. They're just shutting it down because they don't have the demand isn't there. Everyone knows, that's like the argument. People don't follow, like if you've been following Tesla for a long time, like almost every other quarter in Fremont, they would shut it down for like a week just to upgrade things. It's just standard procedure. And demand has been off the hook all this time, so it's not like they're shutting it down. Like GM and Ford have been shutting down plants, I would say arguably because they're trying to keep the supply demand thing in a particular relationship so they don't have excess supply. So, and chips also, but yeah. Anyway, let's move on to your model. We can go on for that for a while. So let's
yeah.
Matt's going to share his screen and just talk us through the model for those of us listening as well.
All right. Can you see it? I'm going to try to make it a little closer up so you can see it. So, is it
Yeah.
coming through all right?
Yeah, it's coming through good. Just keep in mind that you and our pictures are at the bottom white corner. Just they
Right
cover it right
here.
to where the Cybertruck black line is. We can see that, but we can't
All
see
right.
really below that.
I'll use that as a guide.
Okay.
Actually, here I'll just adjust my screen so I can't see that far either. All right.
Okay. Cool.
All
Yeah, that's
right.
perfect.
So, at the top here, we just have the pricing. So the only really change to the pricing, and so just to maybe orient a little bit, my model kind of walks down this way, and then I think the easiest thing to do is to compare the last quarter. So this is Q1 2022 actuals, and then here in column P, this is my estimates for what's going on in Q2. And so I'll kind of walk through some of the things that have changed. So the biggest one is just the price increase Tesla has been rolling out. I mean, even some of the ones that were, 6-9 months ago in the, financials in this most current quarter. So I've got
Q1, just to say it out loud, yeah, 49,612 for Q1 as your average price, and sorry,
Yep.
go on.
Yep. And so I've got that increasing about $900 to $50,500 in Q2.
Is that where'd you get that real quick? I'm sorry, I'm just gonna check in. So that price increase of $900, how do you just kind of ballpark it, or would you have some way to how'd you deduct that
So
$900?
I've been kind of tracking the price increases that have been layering in,
Hmm.
and it's impossible to get a mix of all the different trims that they have, for example.
Yeah.
And even if you do, it's hard to know which price increases will come to which at which point. So I've been tracking these kind of historically. Here, I can actually let me see if you can kind of see how it's changed over time.
Mm,
So there was a
I see.
big jump in Q4 of 21, and it's
Why was that?
possible. So I think that was the first
That's
time that,
$4,000 bump from
yeah,
44,371 to 48,000 for those that can't see.
yeah.
So yeah.
And to be clear, like Tesla doesn't disclose these numbers. I have to kind of back into them based on
Hmm.
the automotive revenue. So it's
Hmm.
possible that there's something kind of going on with the big, with like the mix between full self-driving revenues and lease
Mm,
revenues and Model S and X. Those all get lumped together in Tesla's financials, and then I try to just extract them. But yeah, that huge jump in Q4 was surprising. So to me, the thing that makes the most sense there would be mix shift. So that was kind of right around the time that the Model 3 and Model Y performance were having the much shorter lead time than the other variants. So I think it's probably likely that Tesla did start prioritizing those then, and maybe they got some amount of kind of increase then. But that was also, I think, the first quarter that the price increases started to hit.
mm.
But then in Q1, we actually saw that they were able to increase prices again, even on the back of that. So I'm essentially
Yeah.
just in Q2, you have the same kind of level of price increase that we did see in Q1.
Okay.
And one of the things that I check is, Troy Teslike has that Model Y survey. And so I went back there and I was looking at all the, the trim details and, what were the, performance trims versus, long range and, the whatever. And I wasn't seeing any big changes in, the trims between the vehicles. So
And
my best guess,
does that price include the full self-driving subscription take
it,
rates and such?
it does not. So we'll get down
Okay.
to that in a little bit. So this is just the hardware. So if these look a
Okay.
little bit low,
Yeah,
then
that's what I was
the
thinking.
reason for that is that it doesn't include any of the
Hmm.
software, kind of components.
Okay.
And speaking of which, enhanced autopilot was a new one this quarter. So I added a line here for enhanced autopilot.
Okay.
But this is something like I don't even see any of the Wall Street analysts like modeling acceleration boost, for example, or
Mm.
enhanced autopilot. Not that those are huge money makers, but I think it's important to try to at least take a stab at getting it. And I think that's one of the reasons I've been a little bit more accurate, just because I'm actually taking the time to come up with some assumptions around these things.
Yeah. Well, I see a lot of people say like the enhanced autopilot option is a big plus, but one could also argue, I would think that the people that would otherwise have paid for the 11,500 for full self-driving, some amount of them instead will just pay 6,000 now, right?
Mhm. I
Anyway,
think that's true. So you want to look at like the entire full self-driving take rate. So between the
yeah,
outright purchases, the subscriptions, and like the enhanced
yeah,
autopilot, and make sure
yeah,
your assumptions around those are reasonable.
yeah.
And I'll talk through those when we get down to that section. So this is just the pricing, quantity. Obviously, this just comes right from the production and delivery report. So you got 254,695 deliveries. That was based on the thing that we got on Saturday.
Hmm.
So now we get into what I think is kind of the interesting bit of it. So you've got the full self-driving take rate on new orders.
Hmm.
So I was assuming 15% in Q1. A lot of people think that number is too high, and it's possible that it is. But I've been seeing a lot of, I've been trying to do some like Twitter surveys and that sort of thing, just to get an idea of how this rate may have changed over time. And it does seem likely to me that the take rate is starting to increase. Now that's not necessarily reflected on like Troy Teslake's Model Y survey, for example.
Hmm.
But I think the thing that is maybe not getting accounted for there is just how quickly the technology is improving outside of, well, just in general. So I kept it flat this quarter, but one thing to keep in mind is that if I am too high on like the 15%, then that also means that I'm too low on my manufacturing margin. So it does kind of become a wash because I'm tying these out to the actual results. So that's
Okay.
just maybe a bit of nuance to keep in mind. So I kept that flat this quarter at 15%. I did assume a little bit of an increase in the upgrades. So there's a fleet of about 2 million vehicles that never purchased full self-driving when the
Hmm.
vehicle was initially bought. I thought with how much the technology is improving and how widespread the beta is going now, to me it seems like the right time to assume an increase in that rate. So last quarter I assumed 0.5% of that fleet would upgrade, and I just increased that to 1% this quarter.
Okay.
Acceleration boost, I just assumed 7% of the eligible vehicles opt for that. And then full self-driving subscriptions, I'm assuming 5% of new sales have FSD. So that kind of, if you add that to the take rate on new sales, it's roughly a 20% all-in take rate. So again, it's possible I'm too high there. But then I'm
Okay.
assuming that there's a churn rate each quarter. So I'm assuming only 90% of people renew their subscriptions each quarter.
Okay.
And then enhanced autopilot was added so late into the quarter. I
Yeah.
just assumed 0.25% of the upgrade candidate pool opted for that. So not a big impact item this quarter.
Yeah.
So that gets you to a pure automotive revenue. So this is excluding any of the software stuff up here that we just walked through.
And that's
Um,
13 point for those that can't see,
yeah, sorry.
13.985 billion in pure automotive revenue, excluding full self-driving and credits, right?
Yep, that's right. So then here you've got the cash intake for full self-driving. This is, people pay, $12,000 for full self-driving, but it's not all recognizable for Tesla.
Mm.
A big change that I'm assuming in Q2, based on how the beta program has rolled out both in functionality improvement, but I think more importantly for deferred revenue recognition is the breadth of the rollout. So it was a little bit unclear from Elon's comments if it's 100,000 or 200,000 FSD beta testers at this point. But the last time that Zach was discussing the recognition practices and policies for full self-driving, one of the big factors was both functionality and how widespread that pilot program has been rolled out. So I think it's the right time to recognize some of this revenue. And so I really do think that they're going to recognize a big chunk of it. So what I've assumed here is that the percentage of the revenue that's classified as deferred decreases from 42% in Q1 to 30% in Q2.
Okay.
And that has the effect of recognizing about $480 million of deferred revenue.
Wow, that offsets the Bitcoin impairment pretty much.
Yeah, exactly. Almost penny for penny. And I didn't really do that intentionally, but I was doing some other math of like, okay, well, if there's, 100,000 FSD beta subscribers and, they have an average, deferred balance of, like 4,000, like just under $5,000 essentially, then that would kind of equate to 480 million. If it's 200,000, it could be a lot higher. But to me, I was trying to kind of key in on it from a couple different ways, and this seems about right to me. Okay. And it's worth noting, like the 30% figure that's deferred, like that's not all going to be like all new FSD sales are exactly 30% deferred. Because if you're a U.S. driver and you can get the beta program, they'll probably recognize a lot more of the revenue than if you're in Europe and you've got basically zero functionality. So it's going to be geographically restricted, but I'm trying to look at this on aggregate for the whole company.
Yeah. Okay.
So the interesting thing when you do that, so you've got FSD on new sales, and you've also got recognition of the deferred revenue. That gets to total FSD revenue of about $1 billion, so 947 million. Which is obviously a big kind of margin boost this quarter. Wow. And it would be something, I think the analysts would be really skeptical of this figure right here. But the really important thing is that it...
the figure you're pointing to is the recognition of deferred, right? 479 million.
Yeah. So analysts will be like, they're going to back that out essentially. Tesla will not back out that from, adjusted EPS, and we'll get into that in a minute. But analysts will say, okay, well, they kind of bailed out their quarter by recognizing a bunch of deferred revenue, and that's not really recurring, which is a fair point, and it's one that Gary Black makes, and I agree with it. Like, you shouldn't just like annualize that, for example. But you also, it's important to note, like they did earn, this $1.6 billion that has just been sitting on the balance sheet. They just haven't recognized it yet. So it's real money. And the bigger impact is that going forward, they'll have a higher, a recognition. So one of the interesting things you see here, comparing Q1 to Q2, is that even though the deliveries are lower in Q2 quite substantially, and for the most part, all the FSD metrics are the same in terms of like percent of units sold, there's actually about $100 million of incremental revenue just on the new sales. And so that's the really exciting part, is that you're going to get into the scenario where new sales will be more recognizable. And so over time, you're going to see the full self-driving revenue become a lot more impactful. I believe, especially if take rate goes up, which I'm not really increasing or assuming as a base case. So then regulatory credits, I'm assuming only $300 million of credits here, which is a kind of in line with where they have been historically. It's definitely possible that we have another, huge quarter like we did in Q1, and that would be great if they did. Then acceleration boost, subscriptions.
In Q1, just to remind everyone, they had 679 million in regulatory credits, right? And so in Q2, you're putting in 300 million. So you're coming down more than 50%, like the stock price. I don't know. I think regulatory credits might be like 5. I'll put that in my notes of my stress. I'm taking some notes of things I'm adjusting after you go through your model. All right. If I used your model, what numbers I would put in there?
Sure, we'll do that at the end. So we can probably blast through the rest of this pretty quickly. So adding all this together, there's a couple other smaller items here that I mentioned. It's about $100 million in other, like software type of sales, between acceleration boost, full self-driving subscriptions, and then enhanced autopilot. Lease revenue have got increasing just a little bit. The auto revenue comes down this quarter just because the deliveries are so much lower. Energy revenue, I'm
So
assuming
the total auto revenue you have is for last quarter was 16.861, this quarter 14.64 billion. Yeah.
Yep. And so the way Tesla actually reports it, they'll put these together. So I think it's
Okay.
17.5 was the total for Q1, and so I'm coming up with 15.3 for auto revenue.
Okay.
So then, assuming a bit of an increase in the energy side, I think they're going to have some more deployments of stationary storage this quarter. Q1 was pretty bad actually, so I think that'll bump back up. The big item this quarter, though, and I've spoken about this a little bit, is on the services side. So 3 years ago, in Q2, Tesla introduced the Model 3 lease program. It was a 36-month lease, which means that those first vehicles sold as a lease in 2019 had their leases end in Q2 of 2022. So those revenues come into the services line. And I assume that essentially 4,000 units, which is a little bit less than I think would have been leased. I think they probably leased about 5,000 units, but I've heard some anecdotal stories from leaseholders around that time that they ended their lease early, or Tesla bought them out, like in Q4, for example. So that's it's possible that we're not going to get the full roughly 5,000 leases that I think were issued for the Model 3 3 years ago. But I'm assuming that they sell those at an average price of $55,000, just based on looking at where 2019 Model 3 pricing was. For the most part, the lowest possible lease or Model 3 used price I saw on Tesla's website was around $50,000. Some of them were going for as high as $65,000 or so, depending on spec and whatever. So I think $55,000 is like a reasonable estimate for that. So that gets to a huge spike in services revenue, which I think is going to surprise many people if my theory here is right. So then total revenue is $17.1 billion. It's down about 1.5 billion, 1.6 billion from where they were in Q1. But then we get to margin. So I did a lot of looking at the margin between Shanghai and Fremont over time, and kind of how those were weighted going back historically. And to the best of my understanding, the Shanghai plant has at least a 5% gross margin edge over Fremont. So when I was looking at the kind of weighting of the deliveries of vehicles which would have been produced in Fremont versus Shanghai, that led me to believe that there was going to be about a 4 to 3% decrease in efficiency. On top of that, Shanghai's gross margin is not going to be as great this quarter because they were down for so long. So they were not producing at maximum capacity. So I think bringing their margin down a little bit. I think I had been assuming around a 31% gross margin, just like manufacturing margin out of Shanghai, and I brought that down to around 29%. And then when you blend that together, it indicated about a 4% gross margin hit this quarter. Then I added 1% to that based on the issues that I'm sure are going on with inefficiencies out of Austin and Berlin. So the net effect of all that math and all that thinking was that the core manufacturing margin I have decreasing by 5% this quarter. So it was 27% by my estimates in Q1, and I'm dropping that all the way down to 22%.
Okay.
So it's
and
a
this
very
excludes
steep
full
decline.
self-driving and regulatory credits. Just
exactly. So
listening.
It's just the price of the hardware, less the costs. So pretty significant decline. They've never had a decline, to my knowledge, at least as far as I've been tracking this, anywhere near as significant as what I'm modeling here. But to me, it's the right thing to do, and it seems reasonable.
27% last quarter is what you estimated, and now 22% is what you think it's going to be. Okay.
Yep. So adding that together, you have 3.077 billion in auto manufacturing, like gross margin from manufacturing leases. But then you have a big increase in your full self-driving and your other like software as a service kind of sales. The biggest reason for that increase is that recognition of deferred FSD revenue.
Okay.
Then your credits is 300 million, like we said above. And so the net result is that you have total auto gross margin of $4.4 billion. And on a automotive gross margin, which is what Tesla reports, it drops from 32.9% in Q1 to 30.2% in Q2. So not as significant as a decline as I think some people are expecting. But again, the real reason for that is recognition of FSD revenue. And I could be off on that. And you get about $100 million too. Oh, I don't think I didn't talk about the services margin yet, did I?
No.
Oh, yeah, that's down here. Sorry. Okay. So energy gross margin, I'm assuming just incremental improvement there. It doesn't, really move the needle a whole lot. But then on services, back to this lease methodology, I'm essentially assuming, and I won't rehash all this, thesis around this, but that the vehicles are the lease vehicles are on Tesla's books right now for about $30,000. I think that's actually probably a little bit high, but I want to be reasonably conservative here. And so that would indicate a $25,000 markup per vehicle. So you've got, essentially $25,000 times 4,000 vehicles being sold. That's about $100 million of margin. So this is going to be like the big surprise this quarter, if I'm right, because this is something that nobody's really expecting, and it could be a really interesting talking point. And it's not huge. I mean, it's $100 million of margin. Could be a little bit higher than that, if they're on the books for a little bit lower than the 30,000. But this is a nice kind of dark horse to show up in this quarter, and it's recurring because this will continue to repeat itself in future quarters, but at a larger
As more
scale.
leases come up and there's trade-ins and they sell it for a higher profit margin. Yeah. Interesting.
Yep. So total gross profit of 4.5 billion or 26.1% as reported.
Versus 29% last quarter. 29.1 last. Okay.
Thank you for keeping our audio listeners in mind. I'm assuming R&D stays flat, modest increase in SG&A, and I'm assuming stock-based compensation actually decreases a little bit, partially based on the current stock price and the fact that they have some the cutbacks that they have with letting go a part of the workforce. So I'm assuming they're going to stay relatively flat. I normally have their operating expenses increasing a lot more than this each quarter, but I think with everything going on, I think Tesla would have been tightening their belt all throughout this quarter. So that gets to operating income of 2.6 billion
versus 3.6 billion last quarter.
Okay, so $1 billion decrease. I'll skip, interest income expense. It's a really small amount. I mean, expense, now that I'm looking at this, probably drops a little bit because they hardly have any debt anymore. But then you have other income here, which is where they will record their Bitcoin impairment. So I'm assuming $470 million of Bitcoin impairment. So, netting that against what they normally have, around $50-60 million or so of other income that gets recorded here. But that'll take the hit right there. So then you have GAAP net income after you take out taxes of 1.9 billion. And on a per share basis, that's $1.63 billion. And then
$1.63 per share.
Yeah, $1.63. So you're still looking at this in billions. Yeah, $1.63.
Last quarter it was 286. This quarter 163. Okay.
Then for the adjustments, they actually don't adjust out Bitcoin impairment or the deferred revenue recognition. So it's actually kind of interesting where the quantity or the value of the Bitcoin impairment is almost exactly the same value as the deferred revenue recognition that I kind of accounted for here. So those two essentially kind of offset each other anyway, so it doesn't really matter. They're both one-time items. They're both the same magnitude, like I said. So really the only adjustment is adding back in the stock-based compensation here, and then you're getting adjusted earnings per share of $1.94. Which it's actually pretty close to where Wall Street is right now. I think they're at like 198, but this is probably the first time I've ever been lower than Wall Street on my EPS estimates. But I'm guessing that's just because they haven't updated their models yet. So the average, I'm sure, will kind of come down over time.
Yeah, interesting.
So that's where we are. And I did it's called a waterfall chart to kind of walk through what are the reasons for the magnitude of the decrease. So you've got Q1 adjusted EPS of $3.22. The deliveries just being lower accounts for a 51 cent drop. The manufacturing margin is a 53-cent drop. The Bitcoin impairment is a 36-cent drop, but then the full self-driving recognition adds an extra 34 cents to earnings per share. And then there's kind of like a combinatorial factor of all these things. And then there's a few other items like dilution and, a few other, just small bits of
services.
Services. Yep. That's a positive. But on the net, everything else together is 22 cents of hurt to bring you down to $1.94. So
that's cool chart. Okay. Wow.
That's
so what was Q4 earnings per share? Do you on the chart? It was
I can pull it up here.
Yeah.
So Q4 is coming in here. So 254.
Okay. So the last time it was this low was, I guess, Q3 of last year. It was like $1.86. It says there. So
Q3 they had 241,000 deliveries and $1.86 of adjusted EPS. So this, this track's about right. I think you got slightly higher deliveries than that, but and slightly higher EPS.
Yeah, interesting. Cool. Well, I took a couple things I would adjust, and let's see what my adjustments are. The notable things, if you don't mind, we'll plug them in real quick, and then we'll do a bunch of Q&A. So a few things. The Model 3 and Y average sale price, let's move that up to 52,000. You have 50,500. Let's move it to 52,000. I think the price increases are going to have a bigger impact, because if you go back multiple quarters, you can see how there was that big jump of 5,000 one quarter, fourth, so I think this could be a jump of like $2,500, not $800 like last quarter. Or actually move that to 53,000, because I think it'll regress to a mean of like, so 53,000. Because last quarter, the bump up was only like $800, which was like a small bump up given how they methodically keep increasing prices like $2,000 or $3,000 or more a quarter. And then let's go down to the full self-driving take rate. Let's move that from 15% to 22%. Just because it's been in the news. It's been in the news a lot. I just think a lot of people buying, and maybe there's some rumors that they prioritize deliveries that have full self-driving. I don't know. It seemed like that. I don't think they're doing that, but it just seems like maybe the take rate's a little higher now with all the news and everyone getting the insurance and wanted to know it's on the cusp of FSD and blah, blah, blah. And then there's something else I wanted to upgrade to. Yeah, the upgrade conversion percentage, move it from 1% to 3%. Because at the same time, I think maybe we'll see early adopters more likely to creep in and say, I'm gonna upgrade my car. And then the credits. Where do you have the credits again?
So those are down here.
Yeah, you have 300 million. Let's move it to 500 million.
All right.
And then energy revenue. Go to that one. I want to move that down to 500 million. From 800 million, I'm moving that down to 500 million, less than last quarter.
So sequential decline.
Yeah, just because they have less battery, even though Tesla, didn't produce as many cars, so you could say, oh, they could divert more batteries to storage. That's my first thought. My second thought is all the battery suppliers, like out of China and stuff, they were also down and couldn't produce as many batteries. So I'm just thinking there's probably a decrease.
They did commission a large project for PG&E at Moss Landing this quarter, so I think that might, the huge projects like that really kind of drive energy revenue, but it doesn't really matter because it runs at break even. So it's like, actually, if you lower this but keep the gross margin the same, it's actually increasing your earnings per share. Probably enough.
Yeah. And then go to core manufacturing gross margin.
All right.
This I actually think I want to lower, because you mentioned that you estimate that there's like a 5% difference between Fremont and Shanghai. I think it's even bigger difference. I think it's 10% the difference. So for that reason, let's move the core manufacturing to 20%.
All right.
And let's see what happens. So I'm saying there's a bigger difference between how efficient Shanghai is in manufacturing versus Fremont. So let's see what changes. So I had some pros and some cons.
$2.32 with your adjustments. So mostly good. Probably mostly on the full self-driving side as well. If we go up here, you're at 1.5 billion of full self-driving revenue, which would be, like a monstrous amount.
Move it to 20%. Move it to 20% from 22%. 22% I put in there for the FSD take rate. Go to 20%. Sorry, I changed my mind. 20% instead of 22. That's a little aggressive. 20%. All right, now let's see what it is. How different it is. The
so
earnings per share.
Is that right?
229.
Right. What was it before? 230 something?
I think it was, yeah. Go back up.
Yeah, so, okay, so it's 232, when you had it at 22%, and now
Oh,
it's
so every 1%, it's like a penny
229.
of that? Interesting. Okay.
Roughly, yeah, like a penny and
Penny
a
and a
half, maybe.
half.
Yeah.
Okay. So 220. I'm at like 229. That's my my forecast. Using your model, your hard work, your hard grunt work of the model. I put
Well, that's
in
the
a
nice thing
couple
about
adjustments.
putting a model. This is a pretty simple model, honestly. I mean, it's
Yeah.
very simple. All the work comes in thinking through the different variables, and I do a lot of stuff that I don't show in here, like around the gross margin, for example. So it's
Yeah.
it's
Okay.
I kind of like the simplicity of it, but it's also very complex in the way that it breaks out the software costs and everything like that. So
Yeah. Okay.
anyway,
All right.
that's where I think we'll be for this quarter.
Yeah.
But
And so for anyone who's tuned in on Spaces, this is all on our YouTube live channel recorded, so you can see the walkthrough of the spreadsheet. We tried to verbalize or make it, friendly to auditory only listeners as well, talking about the numbers. But if you want to see the spreadsheet, you can watch the recording once we're done. I guess
yeah,
we have you. Do you want to do like 15 minutes of Q&A? You got time for that, Matt?
yeah,
You just
sure.
want to
I
stop
can do
around.
that. And I did see Larry ask a question about reorg costs too, and I thought about that. Like, there's going to be some amount of severance, but I think it's going to be pretty small, honestly. And I think it's going to get
Mm,
it'll essentially make its way into this like other one-time items, like the Bitcoin impairment loss. And so, like, to me, like the amount of reorg costs, like it could be 50 to 100 million, I kind of think, and that's almost like rounding error in the
yeah.
like the math of like the Bitcoin impairment and everything else. So that's where it would go. I mean, it's a fair point, Larry. Like, it's definitely a real cost, but I think it's going to be small. And to me, it's a question of, do the benefits of the reorg actually offset the what they have to book in terms of those one-time losses. So
Yeah.
I just think it's a small item, and I don't. But
Yeah.
we can go
I
to
see.
Q&A.
I see a comment. Roblox is popping today. It is. It's up like 13%. It was $40 now suddenly. Wow. And
Is it
Unity
really?
is like Unity is up like 9%. So it's up similarly, almost 10%. Roblox up. So there's a lot of buyers coming into some of these high growth tech stocks today. It looks like a lot of the tech high growth stocks are doing well. ARKK is up 7%, almost 6 or 7%. So a lot of it's interesting. There's a whole new like reallocation of capital back towards riskier assets, maybe because of the bond market signaling rates aren't going to be as high as they were previously thinking they would be. So the discounted present value models of these, high tech stocks are now higher valuations today than they were, last week. That's what I'm assuming. So who
Yeah,
knows?
and like, it's kind of interesting. The 10-year Treasury is down to like 2.79% or something like that.
Yeah.
Last I checked, yeah, 2.795. So it's like, just a while ago, that was over,
Like 3 points up,
well over
3.3.
3%. Yeah,
Yeah.
and oil was at 130 or whatever. Now it's sub 100, like Anthony points out in the comments here. So, like, there's a
Yeah.
lot of these really important metrics that are coming down in a way that I think is really good news for stocks in general, and growth stocks in particular. So
Yeah.
yeah, it's
Yeah.
a there's some good signs coming out right now that we could be
Yeah.
in for a bit of a boom, but I'm not going to bank on it.
Yeah. All right, let's go to the Q&A. Alec, if you want to queue up maybe 15 minutes of questions here. So from Tesla SpaceX fan on Twitter, with Tesla at 650, well, now it's at 685. All right, was Tesla at 650? Are you starting to buy June 2024 leaps? I would say the key word is starting, and I would say no, we're not starting. Okay. All right, next question. Next question. All right, from Yarmar74 on Twitter. Does the interview you guys posted yesterday shake your conviction in Tesla reaching mass production because of lithium issues? That's what we just talked about in the beginning. So I think we answered in the beginning when we were talking. These questions are a lot more from earlier before we even started the chat. Let's go to the next question. From Jay Browen in the YouTube comments, Emmett, why did you decrease core margin while increasing average sales price by 2,500? Oh, that's a good question. I think that the core margin is a big difference because of the Shanghai efficiency. Like the core margin, I decreased because Shanghai has been shut down most of the quarter, and my feeling is that Shanghai is really the breadwinner for Tesla up till now. Fremont manufacturing in California, in the Bay Area of California, with all the restrictions and regulatory, that's a nightmare and a half. Like, for them to be operationally profit is a miracle just in Fremont alone. I don't think, I don't know. I don't know if they break it out by factory, but I would imagine if they
No.
broke it out by factory, I'm sure internally they do. But
Yeah.
I would imagine if they did, if we saw that, Shanghai would be like monstrously more profitable, especially the cars they export to Europe, and sell for higher average sale prices than in China. And they've exported a lot of cars to Europe, over the last several quarters. So that's why I changed it, because I thought that the delta between Fremont efficiency, which was up all quarter, versus, and did most of the, the production this quarter, is so different versus Shanghai's efficiency. Anyway, next question from Blake Anderson. Matt, I'll let you take a first stab on this. Thoughts on Rocket Lab facilitating NASA to the moon? I thought it would be a catalyst. Will it possibly go to $2?
$2, I'm guessing, or
Yeah, I guess that's what it means. Yeah.
Yeah. So for those who haven't been following it as closely, they had this moon mission, or it was like a week and a half ago, something like that. But the really interesting thing about this orbit that they have is that it took about a week and a half to successfully complete the mission, because they had to do a series of, I think it was 7 different burns on their Curie kick stage engine that they have. And the thing I loved about it was they were talking before the launch even about how like this mission like really stretched like every inch of performance they could get out of their vehicle, but it still did it successfully. And they actually combined 2 of their burns together, because the Curie engine was performing like better than expected, essentially. So I think their last 2 burns, they actually did it just as one large burn. So it just shows like the performance of these rockets is like phenomenal, and it's, even when stretched to their limit, it's kind of exceeding expectations. Similar to what you saw when they actually brought one back in through the atmosphere and recovered it. It was like, oh, it actually like held up a lot better than we thought it would. So like Rocket Lab, I'm trying not at all to focus on like even the next 2 years with Rocket Lab, because it's such a longer term investment for us.
Yeah.
I think it's going to be like I've never seen like a mission be a catalyst for any of these rocket companies. It's like blowing up can be a negative catalyst, but successfully completing even a really cool mission doesn't ever seem to be a positive catalyst. So I don't know how low we go, but I think the valuations are kind of getting into kind of hilarious territory. And I'm happy to own right now. And if we had some more liquidity, I'm sure we'd add on some more.
Yeah. All right, let's do a couple more. If you have some questions you want to ask, you can put them in the YouTube live chat as well, and we'll try to pick any interesting ones up. Alex, you want to pick up the next question from Jeffrey Hoffman in YouTube live comments? Do you think the only way for Tesla to increase their share price is by increasing their yearly earnings per share? So I guess that's, investors have to buy Tesla stock, in order to for the stock to be sold at a higher price, and that's where the price would be higher, is if there's not as many sellers willing to sell it at this price as versus $1,000 or $2,000 a share, for example, and more people want to buy it at $1,000 or $2,000 a share. And there's a lot of institutional managers that pay very close attention to metrics like price over earnings ratios, and so that's if their earnings per share goes up, then their price to earnings ratio becomes more attractive, especially the rate at which it's growing, their revenues and such at the same time. So yeah, I mean, I think as their earnings per share goes up over the medium to long term, their share price would go up. But it's hard to quarter to quarter or even year to year. You can't say for sure. Any thoughts you want to say, Matt?
Yeah, I retweeted a great chart that Bad Frenchies on Twitter pulled together, and it was basically like assuming Wall Street average, EPS estimates, and then Gary Black's EPS estimates, like at various different PEs, from, I don't know, maybe it was 30 to 70 or something like that. What would the share price be? And it just shows like if Tesla can actually deliver, and for the record, I think Gary's numbers are actually too low on his 2023 and 2024. So, if Tesla just hits like a couple, singles, couple doubles in the next couple quarters while they're, ramping up capacity, and, start posting, $4 and $5 quarterly EPS estimates, then, everyone has to kind of reassess the E part of that, PE equation. And so even if the PE ratio gets, squeezed down to some number that's lower than we think it should be, well, that you're kind of backstopped by the like manufacturing efficiency and the earnings power of the company. So that's kind of what we view as like a backstop case when we're thinking about like risk and valuation and how to think about the next couple of years. So you've got a pretty decent backstop just based on that, and then all the other, if FSD takes off or Optimus or whatever, we think there's other great optionality on top of that. So the only way, no, I would not say the only way for Tesla to increase their share price is by earnings per share, but that's like the easiest, maybe not the easiest, but the most probable way for them to increase earnings or share price in the medium term.
Yeah, next question from American Yoshi on the YouTube comments. What do you guys make of Troy Tesla's decreasing orders comparison for Q1 chart on Twitter a while back ago? Are there any markets Tesla isn't delivering to or taking orders from? So I'm not sure what this is referring to. I don't recall
seeing that chart.
Yeah, decreasing orders chart. And for the second part, are there any markets Tesla is not delivering or taking orders from? I mean, South America, do they take order? I don't like they have to have, I think they have to have delivery centers in order to take orders from there. So do they even take orders from like South America? Like how are people going to get delivery? So like there's parts of Africa, Middle East, maybe even. So I think they have to be in the region of like, they have to have service centers in the country at least to take orders from that country or that region, I believe.
Yeah, I mean, it's true. And was it like Australia and New Zealand? They recently opened up, and like the wait times got really shut down. It was like a 12-month extension in wait times, like the first week after those geographies opened up. So this is something I'm trying to watch really closely. I'm constantly looking at the lead times for all the different trims and in different geographies, because based on where the economy is right now, it makes sense that you should see, decreasing orders. But I don't know, the data. I haven't seen this chart. If it's based only on the, the Model Y kind of order survey, I'd be a little skeptical of that, just because I think the sample size is so small. I mean, talking about like 1,000 or 2,000 vehicles reported per quarter, I believe, out of a, magnitude of around 300,000. So you're talking about like, 0.2%, 0.3% of the total orders that are reflected in that survey, if that's the source. So not that it's not a good source of information. I use it all the time, but it's hard to extrapolate too much from that. But I do think it's definitely worth trying to keep a pulse on our orders decreasing.
Yes. Next question from Blake Anderson. Do you think Rocket Lab getting into the business of making satellites applications potentially very bullish? I mean, that's been our thesis from the beginning, I think, is that they're a space services provider trying to be, do the vertical stack of, building the satellite services, launching to lower Earth orbit, taking over the reaction wheels process, which is like the part of the satellite that rotates the satellite to turn, and such. So they're trying to, I think, vertically integrate as much as they can, and whatever the space industry is going to become. And so, in the near term, we don't know what's going to happen with Rocket Lab. So it's sort of like investing in a venture company fund in a way, investing in Rocket Lab. Like you really have to be in it for the long haul, and when the space industry takes off again, or like when the valuations of the space industry stocks take off, we think Rocket Lab will be like the obvious winner. Like, you got to own Rocket Lab if you want to own some of the space industries. Forget this Virgin Galactic Space. Forget this, Astra or Planet Lab. In our opinion, Rocket Lab seems to be, SpaceX obviously is number one by far, but if you want to invest in something in exchange traded markets and something that's number two, the clear number two, it seems to us that Rocket Lab, it takes that reins easily. And the more we study it, the more success they make of these missions. It just seems more obvious. Peter Beck is sort of an incredible founder and running a very tight ship there. So, Matt, anything else you want to add?
Yeah, no, I agree with everything that you said. I mean, the more I get into this market, the more I'm just kind of convinced that most people who are dabbling in this market just don't understand like what the hell they're talking about, or like what they
Yeah.
think the potential is. It's just like, oh, like rockets, that's cool. Like even ARC's space exploration fund, which I've got a lot of respect for ARC, but they've got like Netflix and John Deere in there, and they don't have Rocket Lab. So to me, there's a lot of education that needs to happen, and I think it's just going to take some time. Possible that I'm wrong, but the more I dig into it and try to understand the industry and where it's going and where the future profits are going to be, I think it's going to be in these like space-based constellations, similar to what Starlink is doing, and that's Rocket Lab's like vision is to do that, and they're doing it right now in just such a profitable, efficient way. I just like it just rings of like everything that Elon has done at SpaceX and Tesla, with just like ramping to like achieve these ridiculous things, but doing it really cost efficiently. So I'm super excited about the company long term, and I don't know how long it's going to take for the market to wake up.
Yeah. All right, let's do one more question from the moon on
All
YouTube
right.
Live. What about the credit rating of Tesla? Will a change in the credit rating be a catalyst? Yeah, that's something that comes up periodically, and I know Gary Black's been tweeting about it a long time. Like S&P, one of the catalysts is, and I do think there will be a catalyst for the S&P. It might not be like immediately that day or that week, but I think over the coming weeks and months after the credit upgrade after Tesla becomes technically investment grade, and then I think there's a whole lot of like, you know, mutual funds or institutional managers out there that, written in their rules of their investment fund, they're not allowed to invest in stocks that aren't investment grade, for example, and now they're allowed to invest in Tesla, and they will. So I think that marginal amount of added buyers to the marketplace for Tesla stock, added owners of, wannabe owners of the Tesla investor stock, I think that will have some effect on the stock price. I'm not sure how marginal, whether this, the stock, in a nutshell, if everything else was equal, if the stock would be up $200 more than it would be otherwise, or $50 up more than it otherwise would be. But I think there will be some marginal effect on the stock price that could take a few months to kind of take place, but we'll never really know because the markets are always moving in that time frame anyway. So what do you think, Matt?
Yeah, I mean, this is like I just lose all respect for S&P, because this is the same company that does the credit ratings, but also does like the ESG index, and it's so ridiculous that it doesn't have an investment grade rating yet, and it's kicked out of the ESG index. So like it should be a catalyst, but I think like you said, Emmett, it's nothing like the S&P 500 inclusion. It should be it's like a nice to have in my mind. It's not
Yeah, nice to have for sure, and it'll help, but it's more just, yeah, it's hard to say how much. It's nothing like the S&P inclusion, though, that's for sure.
yeah.
Yeah.
So one comment I see too on the side, Boil Down AH says, oh wait, who was it? Did I lose it? Somebody was saying, anyways, that Rocket Lab's rockets are too small to effectively deploy Constellation, and that's true right now. But they're developing a larger, fully reusable rocket, which I think should be much more cost effective. But in my mind, even if Rocket Lab just has to exit the launch business completely, because SpaceX is just so much cheaper than everybody else, well, that's fine. Like I think Rocket Lab still really thrives in that environment, because they are like, so they're such a key supplier for other things like software that other providers are using, and reaction wheels, like you said, Emmet, and they're working on developing their own kind of constellations. That's like the end goal after they get to like full reusability on launch. The real kind of much larger TAM, much larger money making opportunity is to provide space-based constellation services, and you can just contract with SpaceX to do that if you have to, like if it's just so uneconomical to do it yourself. So yeah. I think it will be economical for Rocket Lab to do it themselves, but even if it's not, I don't think that's like a thesis killer.
Yeah. Even if Rocket Lab is just forever picking up the crumbs of SpaceX, at the current 1.8 billion valuation, that still seems attractive to me, but I don't think that's going to be the case for But even if it was just eating the crumbs off of SpaceX, and which, some people might argue, and that's okay, but look at the valuation, that's what you got to look at. Like, we're not saying Rocket Lab and SpaceX should be comparable, but 1% valuation of SpaceX. Don't you think that it should be something like that at least? So you look at Rivian versus Tesla. That's like, and Rivian is a much worse case for a second place to Tesla than Rocket Lab is second place to SpaceX in my mind. And Rivian has like a market cap that's like 10% of Tesla or something. It's ridiculous. So, yeah, I think over time, Rocket Lab will, and maybe it'll take when Starlink goes public. Maybe when Starlink goes public, maybe that'll beef up the space industry again, and Rocket Lab and others will, ride on the coattails of more investors getting interested in the space industry again. That's one theory potentially.
Yeah, and on the comparison between Rivian and Rocket Lab is potential number two is like the really interesting thing, I think, when you look at Rocket Lab is they already have like really healthy positive gross margins and like a huge, it's like a 10-year backlog if they just kept their current revenue the same. It's like a huge amount of backlog, and they've got profitable, at least gross margin operations. So they really just need to kind of scale up in order to better service their backlog and eat through it a little bit more quickly. But like their margins are already like phenomenal. But if you look at Rivian, they're minus 500%. So it's like you need like several orders of magnitude improvements in their manufacturing operations and scaling in order for them to like make it work. And they're still at what would you say, 10% of Tesla's market cap versus Rocket Lab's 1% of SpaceX's. So it's like there's inefficiencies in the market, I think, where people are not necessarily connecting the dots of which companies are likely to be successful in the long run and at what valuations. So this is like we've been saying, I don't know how long it's going to take, but something about that math doesn't add up to me.
Yeah, no, Rivian is now down to about 4% of Tesla's market cap. Yeah, but it was at one point above around 10% or more. Yeah, but even at 4%, that's ridiculous. Because there's so many second place. They're not a clear second place. I don't know. Anyway, we can go on for a while about that, but yeah, it's been a great episode. We went on for a while. Anyone who missed Matt's demo and screen share of his model, it's recorded on our YouTube live channel as soon as we end this, and really helpful. Thanks, Matt, for showing it to us again and walking us through it. And we'll see right around, you're a little bit below $2 a share. I'm a little bit above $2 a share. I'm at like $2.30 per share based on putting some of my assumptions differently than yours on your model. And you're around $1.90 or something per share, I think, right? $1.94.
Yeah, $1.94. Yeah.
Okay. So it seems like, that's, we'll see where the actual number comes in a couple of weeks. They announced their earnings date 2 weeks from tomorrow, I think. Yeah.
Yep. So
cool.
Good. I think you and I are actually tied up. It's like the first time in several years I'm actually not going to be able to listen to the earnings call live. So
yeah,
I'm
me too.
About that, but
me too.
We'll catch it up. And if you're going to miss any quarter's earnings, this is probably the right quarter to miss. So we'll be back strong.
It's all as expected. I feel like the weird quarter, it's all like the deliveries are expected. It's probably going to be like right in line with analyst estimates, which is your estimate, it seems like. So this is like the one quarter where everything's kind of boring and exactly what people predict almost. Yeah. So, all right. Well, we'll leave it at that. And thanks, everyone. We'll see you next week. Same time, same place. All right.
Thanks.
See you, Matt.